Hello guys, welcome back to my channel and don't forget to like, comment, share and subscribe. The precipitous slide in Japan's currency has run so far and fast it's sparking big investors and some are cutting bets that it will decline further. And anticipating policymakers may soon step in to try and arrest the free fall. Those who have sold the yen short have prepared Jesse. It slumped to a 24-year low on Wednesday and has lost some 30% since the beginning of last year as US interest rate expectations have gone up and Japanese rates have gone lower. But this week's almost 3% drop without any particular trigger was enough for some funds to call time on the first leg of their wager that Japan would have to quit its policy of capping bond yields as its global purse rate hiker. We think we are getting close to an inflection point of policy, said Blue Bay Asset Management Chief Investment Officer Mark Dowding, especially as inflation starts to pick up. We have maintained a short stance in GGB as an expression of this and today have actually moved long yen. He said, referring to the government bond market. We think the slide in the yen has gone too far too fast and we think that we will hear something from policymakers pretty soon. Eunice, Eunice calm in the market after a two-session selling storm suggests the feeling is perhaps more widespread or at least that yen shorters are wary of adding to their positions. Positioning data shows yen short have been reduced steadily since April. We're not shorting the yen anymore and we're not long, said Akisai Kamboj, co-chief investment officer at Haida Fund Crowfund Ventures. We're just breathing and watching. Whenever we see the right indicators, we will take some action. Government officials have been tightening verbal terms of intervention and is at their strongest warning to that on Thursday. Without action, however, the yen was left vulnerable at about 14 to the dollar. The big dollar or yen hike at 14 is the natural target, said Deutsche Bank strategist Alan Ruskin, adding intervention rates would increase as it narrated. It would not be surprising to see substantial yen long set up on its approach. The yen has not been alone in sliding lately as the US dollar has zoomed to multi-decade hikes on the euro and sterling on a combination of risk aversion and interest rate expectations. But it has suffered much because Japan is alone among major economies in enforcing near zero interest rates, while the rest of the world scrambles to hike them to contain inflation. After years of hike, asset buying failed to push inflation to its 2% target. The Bank of Japan adopted yield curve control in 2016, where it guides short-term interest rates at 1% and the 10-year bond yields around 0%. This has driven cash from Japan to higher yielding investments abroad, and it has also attracted funds such as Blue Bay Woods, but the policy wants less, leaving the market prone to a violent response if there were a policy change. There will be a very sharp reaction to the policy response from BOG, said Edi Al Hosseini, senior currency and rates analyst at Columbia Trade Nedley. Okay guys, maybe that's all from me. Thanks for watching and don't forget to like, comment, share, and subscribe.